Hey everyone, lots of fun articles in the news these days and seem to usually have the word inflation attached in many cases. And we thought that's relevant. That's something we should probably talk about. What does inflation mean for investors? And we invited Big ERN from Early Retirement Now onto the show to have exactly that conversation. Welcome to the ultimate crowdsourced personal finance show. This is Choose FI. All right, guys, very excited to have this conversation today. Inflation, it's what's in the title. It's what we're going to be talking about. What does it mean for us as everyday investors? How do we interpret what we're hearing and we're starting to hear in articles and in the mainstream media? Like, what does it mean for us? Do we change anything? Do we need to make any changes in our day-to-day life or in our investing patterns if this is, in fact, something that is headed our way? I'm very excited for this conversation. To be honest with you, I don't know exactly where it's going to go, but to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. And isn't that the most exciting kind of conversation, right? Like there are all these topics that are extraordinarily interesting. Like you said, we're hearing about it not only in the media, but you see it in real life sometimes, right? Like prices are going up. That's fairly demonstrable every time you walk into a store to buy. You know, if you have a home project, right? Lumber is going up. You see house prices go up. Like, what does this actually mean? Is that inflation? Is that appreciation? Is that supply and demand? You know, you and I don't know, but the nice thing is Big ERN does. So Big ERN, with that, welcome back to Choose FI.
Thanks. Glad to be back.
Well, let's just start ERN with the price of lumber. Let's sort this. Well, definitively. No, I'm just kidding. Let's take a step back, and I'd love to just throw a couple things just to start the conversation, and maybe we can take a look at this from your perspective, what it is that you're seeing, how that matches up. Recently saw an article talking about the consumer price index. There was inflation of roughly 5%, and I believe the target is normally in between 1% to 2%. I think the chairman of the Federal Reserve came out and said that we had just seen an inflation of around 3.4%. So clearly inflation that is being reported to us is coming back a little bit higher than what we've seen in the past. We've also seen some volatility with the 10-year Treasury yield, and Brad just mentioned commodity prices seem to have done some crazy stuff as of late. What are you seeing and your reaction to that?
Right. So first of all, just to set the stage a little bit, right? So there are roughly 4 different flavors of inflation numbers that people look at. So there are 2 main indexes. One is the CPI, Consumer Price Index, and one is the PCE, Personal Consumption Expenditure Deflator. So what we just recently heard about, so that's the roughly 5% year-over-year inflation rate, that is the CPI index. And then again, the CPI index comes in 2 different flavors, right? One is the overall consumption basket, and one is the so-called core inflation basket. So you take out the volatile components, food and energy. And even in that core basket, you still had about 3.8% year-over-year inflation. And that is hands down a lot higher than what anybody would be comfortable with, certainly long-term. Short-term, well, I mean, we have some fluctuations in that index. Right? Sometimes it overshoots, sometimes it undershoots. For example, middle of last year, we had only about 1% year-over-year inflation because we had that bit of dip in the price index. So now we have a little bit of an overreaction on the other side. So some people would say, well, maybe this is only what's called a base effect, right? Because we are now rolling through, if you look at year-over-year changes, right? I mean, how much of that is really due to accelerating inflation right now over the last 1, 2, 3 months? And how much of that is due to exceptionally low inflation, exceptionally low price index a year ago, right? Because the year-over-year change is you divide today over a year ago. If a year ago was exceptionally low, part of that high number comes from that exceptionally low price index a year ago. Now, the bad news here is a little bit that it's not just that base effect. It's not just that we are rolling through that little bit of a dip last year, but if you look at the change in prices just over the last 3 months, they grew at about an 8% annualized rate. So out of that 5% annualized inflation, 2% came just over the last 3 months. So this is an annualized pace of 8%. So there's definitely a bit of an acceleration in inflation. It's not just the base effect. There's another consumer price index. There's another inflation index that's called the PCE, and that's the index that the Federal Reserve looks at more. So that's constructed out of the consumption numbers that flow into the GDP numbers. And again, there you too have the headline index and the core index. The composition is a little bit different, and there's some technical differences in the way they're constructed. And that is the 3.4% index that the chairman mentioned. So the Federal Reserve believes that that index is going to go up by about 3.4% in the 2021 calendar year. So it's a little bit less scary looking than the CPI, but again, it's significantly above what the Federal Reserve would normally be comfortable with. They're looking at somewhere around 1.5% to 2%.
Carson, if I could just jump in real quick. I know you said there are 4 flavors of inflation, and obviously I don't want to cut you off. But even just taking a step back for just regular people, right? Like at its heart, what is inflation? Like at its most basic, like why do prices go up, right? Like, I mean this very sincerely. Like a cost of a movie, you always hear like it was a nickel in my grandparents' day, and now it's $12. Or the house that I grew up in was $40,000 in 1980, and now it's $500,000. Like, can you just explain in a very elementary fashion like why prices go up?
So the economists would say, it's the Federal Reserve expanding the money supply, right? Because because we obviously we expand the scope of the economy, right? We have real GDP growth every quarter. Sometimes we have recessions, but on average we grow probably at about 2 or 2.5%. But on top of that, there is also some very slow creeping up price increases. And by the way, it hasn't always been like that, right? So we had more or less zero average inflation 100 plus years ago, but a lot of volatility in it. So ever since we've transitioned to what you call a paper-based money, right? So where money can be created essentially out of nowhere. It's actually that central banks can create more or less a relatively stable and low inflation. And some people would say that we want to have a little bit of an inflation rate. It shouldn't be too high. It shouldn't be too low. It shouldn't be negative. So people use these analogies as greasing the wheels of the economy, that we have this little bit of inflation. It means that nobody is just going to sit on their pile of money and not spend it or not invest it, for example, right? So you want to, but you don't want your money to be such a hot potato, right? That the minute you get it, you have to spend it. And think about, and in some of these hyperinflation episodes, say in Germany in the 1920s or in some other countries where you have such high inflation rates that people try to get rid of their paper money as quickly as possible. So we have this sweet spot, right? This Goldilocks inflation rate, which is not too hot, not too cold, where we have low and stable and predictable inflation. And so it entices, in some way, it entices people to do something with the money that they have. People are not just going to put their money under the mattress or keep their money in a bank account and not do anything with it. There's this a little bit of this urge that you want to do something productive with your money, and that 2% or 3%, maybe 1.5% to 2.5% range of inflation, apparently has become this norm and this sweet spot that central banks and businesses and consumers, everybody seems to be happy with that.
And you said central banks plural, right? So this is like, is that a generally accepted number worldwide? Like, obviously I don't know anything about this, but the 1.5 to 2.5, is that like generally accepted businesses and banks?
Right. I mean, that seems to be and again, different central banks have different objectives. So, for example, in the United States, our central bank is tasked with creating stable prices, and also is tasked with smoothing macroeconomic shocks. There are some central banks that explicitly say that we only target the inflation rate and everything else is just going to fall into place. And they say that if we have low and stable inflation, everything else should fall into place automatically. And we don't. And again, they may say that. And of course, the reality catches up to you, and you have the global financial crisis or the pandemic crisis. So sometimes even those intentions they will be thrown overboard. And but I mean, yeah, by and large, that 2% range seems to be the generally accepted decent and productive range of inflation. Yeah.
I want to talk about when you mentioned expand the money supply and just get very clear on that for people in terms of what we're actually saying there. So expand the money supply is adding new dollars to the economy that did not exist before. And so when we say that, hey, we're doing a stimulus package of $6 trillion last fall or whatever, and then this year again, we're doing another stimulus of another, six, whatever, pick a number, some insert of saying incomprehensible number that doesn't make any sense to anybody. We don't even take the time to print the money anymore because that would be too, carbon inefficient. We just it's electronic. It's just, hey, it's there. And so I think in aggregate, I was reading a statistic that said that over the past 12 months, and this was a few months back, and I think we've done another round of stimulus since then, but over the past 12 months, 25% of all the money that's ever existed in the United States history, monetary supply, has been added. 25%. It's kind of like most of our weight over the last 12 months. You're, 25% heavier. How do you feel about that? Well, a little sluggish around 3 p.m. Right. I think I'm a little probably more maybe hypersensitive to this topic just generally, just because, you just mentioned Germany in the 1920s. My wife's from Zimbabwe. I've held the $1 trillion notes. You mentioned the Goldilocks scenario. Like there is the other side of that, which is hyperinflation. You said that needed to be, obviously that's not good for anybody. And I think, we first is just kind of sorting out, is this a transitory type of inflation? How do you assess whether this is a transitory thing? Or how do you go into prepper mode? Or, when to know, is this a prepper mode? I'm going into Zimbabwe circa 1988 or Germany 1920, or is this a transitory inflation? We just had a really rough year. We're making some adjustments. We're getting back on track. And in the meantime, I need to take some natural precautions, or maybe I don't need to do anything. I think I'm still assessing what does this look like, but gaining 25% weight over the last 12 months, it makes me feel very sluggish.
Right. So a few things. Right. So first thing, there are two different aspects of policy we should look at. Right. One is fiscal policy and one is monetary policy. Right. So obviously we have all of these fiscal stimulus plans. We have unprecedented government expenditures, government budgets. But that's not exactly one-for-one related to an increase in the money supply. So think of money again as the oil in that machine, because we have an economy that's not based on barter. If I go to Walmart, I can't pay for my groceries by giving financial advice or safe withdrawal rate planning advice. I use money, and so we need money as a medium of exchange to interact in this modern economy. And there's obviously this issue that more money. At least traditionally, and this is what everybody learned in economics, that more money chasing the same amount of goods tends to create inflation. So hence the reference to Germany in the 1920s, the Zimbabwe hyperinflation. I think I also have a few $100 trillion bills. They are worth a lot of money now. They're collectible.
They're actually going back up.
Don't throw them away. Not $100 trillion, but I think they're worth about $20 US now. So, funny thing is that the experiences in some of the more advanced economies has been that more stimulus, more monetary stimulus, higher money supply, low interest rates, more government spending, and more debt, which, again, there were all of these historical examples where that led to hyperinflation. We now have a few examples where this was not true in some of the advanced economies, right? Japan has a lot of monetary stimulus, fiscal stimulus, low interest rates for the last 30 years. So much of Europe has very low interest rates for the last 10 years. So they've been trying to, quote unquote, engineer a little bit higher inflation to obviously inflate away some of their debt burden. And it hasn't worked in Europe. So quite intriguingly, and there's some economic explanations for that, but quite intriguingly, this higher money supply also has some of this feature of pushing on a string, right? I mean, you can pull on a string, obviously that has an effect, but pushing on a string has no effect. And I think that some similar mechanics could be at work in some of the monetary policy that we've seen in Japan over the last 30 years, in Europe over the last 10 plus years, and potentially also in the US. Even though, I mean, I want to monitor inflation trends in the US and see if it works out differently here. So my point here is that all of these government fiscal stimulus plans and monetary stimulus plans, they are usually referenced as, yes, this is all going to create this tinder that will eventually set off this inflation fire. But there could be reasons to argue that maybe that's not going to cause inflation because it hasn't, not in Japan over 30 years, not in Europe over 10 years. It remains to be seen what experience we'll have in the US there.
So I think for me, if we're kind of working through this, we kind of started with what are the different indicators that we're looking at. And I think the next question that builds on that is, how do these indicators help us determine whether or not we're looking at some sort of transitory or short-term inflation, or whether or not we're trending towards hyperinflation? Do we have to just realize it in real time? Or is there anything that, can we use some judgment to say, I feel like, right now we're just going through a season, inflation versus hyperinflation, where are we at and what are we watching to determine if we're trending from one to the other?
Right. So if we look back during the 1970s, right, that was the last time we had serious and unpleasant inflation. And what people called it back then was called the wage price spiral. Right. And basically means that you had an external shock. Energy prices went up. We had the oil shocks. That created inflation. And employees asked for higher salaries. They got the higher salaries, and that caused more inflation. And so you had this self-fulfilling prophecy of higher prices creating even higher prices. And so the question is, do I believe that we have a similar scenario ahead of us? And I would think that I think there's reason to believe that this is going to be less serious. So, I mean, because you mentioned lumber prices, for example, right? So the lumber industry is obviously an industry that So you mentioned lumber industry, right? That's definitely a line of business that is going through some major price hikes, and it's an industry that can't go online or offline very quickly, and so we have the surge in demand. People want to. But everybody now wants to remodel their bathrooms and their kitchens, and it's very hard for that one industry to keep up with supply. Now, my belief is that some of these demand surges are transitory, and that means some of the price increases will be transitory. And then not only will we see a normalization of lumber prices. So it's not like we have lumber prices going up by 100% or 200% over the last year. And then over the next year or two or three, they will again go up by only, quote unquote, 2%. But there's hopefully going to be then also a normalization where the price went up 100 or 200%, it will probably also then go down by 50% or 66% to bring not just the rate of increase back to something more normal, but even to bring the price level back to something more normal. So there's definitely some justification for these price gyrations to be transitory, because I don't believe that there is some kind of a global lumber cartel that has increased lumber prices by 100 or 200%, and then it's a lumber cartel that will keep these prices up at these levels. So it's obviously it's a competitive market, and there's a lot of suppliers and a lot of people demanding this stuff. It's my belief that, say, hopefully, in contrast to what we saw with OPEC in the 1970s, that a lot of these price increases that we saw over the last year are going to be transitory, and we might even see a little bit of a blip in prices to normalize, not just the price increases, but also the price levels.
Yeah, that's interesting. You'll in regular conversation, you'll hear talks of skeptical people of once the prices are up, they're never going to raise it, or they're never going to lower them back down. But you're saying this is truly economics, right? It's supply and demand. There are going to be, like, there's no cartel. There are going to be some competitors that lower their price, and then who's going to get more market share? They probably are, until other people keep lowering their price. Will it ever go back down to January 2020 prices? Maybe, maybe not. You said, you wouldn't be surprised to see 2/3 of it come back, but obviously you're not forecasting that, but it is interesting, right? Like, it's because this is the water cooler conversation, because people are seeing this every single day.
Right. And so one other thing that we should also keep in mind is that, again, I mean, there will definitely be some people, both in the government in general and also at the Federal Reserve, that might actually like the idea of a little bit more inflation, because as I told you, I mean, there's some central banks that have tried to, quote unquote, engineer higher inflation rates, and they were not able to. And if you look at, say, starting during the global financial crisis, inflation rates have been relatively low, right? And they actually, over the last 10 plus years, on average, inflation was undershooting a little bit that target of that. Say you have a 2% inflation target, and you don't hit that 2% target every single year, but if you do the cumulative effect of all of the inflation undershooting occasionally, right, and that you pile that all up, I mean, you are at probably 2 or 3 or 4, depending on what inflation index you use. You have less inflation that has accumulated to probably around 2 or 3 or 4 percentage points. So if we have a year or two where we have higher inflation rates, at least temporarily, I would be shocked if people in the government are running around with their hair on fire on that. That might actually be welcome. Again, it's something that central banks and governments have been trying to, quote unquote, engineer for a while, and it hasn't worked all that well. And now we have some inflation. Enjoy it while it lasts, because, for example, the Federal Reserve, they just came out this week. We were recording this on June 17th. So yesterday they came out with their new projections, right? There's definitely the Federal Reserve believes that this is transitory. We have a boost in the inflation rate in 2021. 2022, 2023 is all back to normal again. And if it works out that way, nobody at the Federal Reserve is going to get too worried about this one-time transitory inflation shock.
So in very broad terms, so if they're targeting, like you're saying, we're talking theoretically, right? Like they're targeting that 2 to 2.5%. Just hypothetically, if inflation came in at 1% a year for 10 years, like what would the practical ramifications be? Like nobody knows this. Regular people don't understand, like, why are they targeting that? What actually happens if it's too low, too high, et cetera? I'd love to just hear what happens.
Right. So the one really big and prominent lever that the Federal Reserve has is interest rate policy. And so the rule of thumb is that you set your interest rate to respond to the two major observables, right? So you want to, on the one hand, you want to stabilize the economy. So if the economy is going through some trouble, you go through a recession, you want to lower the interest rate. So your interest rate should be positively correlated with your with GDP. And I don't want to get too technical, but this actually what they're looking at is called the GDP gap, right? So they're looking at what is the trend GDP path and where are we actually? And if we're below that trend growth path, that means, that means the economy is doing poorly. So we can afford to lower interest rates a little bit. And then likewise, if we are above that, then we're going to raise interest rates. And the reason for that, by the way, is also twofold, right? One is, for example, in the US, we have a mandate of the Federal Reserve to keep an eye on the economy, right? So to foster employment, full employment, or close to full employment. But the other reason is that, for example, if the economy is running at above this trend growth path and running at above capacity, so there's also this demand shock argument that, hey, I mean, that might create future inflation, right? Because the economy might be overheating. Well, that's high inflation, so we want to raise interest rates to cool down the economy. And likewise, if the economy is running below capacity, hey, we lower interest rates, we prime the pump a little bit. We make mortgages cheaper. We make business loans cheaper, and that's the way we stimulate the economy. So both from the GDP side and from the inflation side. So the Federal Reserve Bank, the Federal Reserve, and or other central banks, they would monitor their inflation rates and where GDP stands both in absolute terms and then also relative to some trend growth path, and then set the interest rate accordingly. And again, because the interest rate definitely has some impact on the economy. It may not impact you or me directly, right? But short-term interest rates, they will eventually feed into longer-term interest rates. They will feed into home equity lines of credit, right? That are tied to the prime rate. The prime rate is tied to to short-term interest rates. There are a lot of touch points where what the Federal Reserve does is definitely going to impact the economy. So that was at least traditionally the one prominent policy tool that the Federal Reserve had. Then obviously, so that's what we learned during the global financial crisis, and then again during the 2020 crisis, that some other monetary policy tools also come in. So, for example, bond purchases, right? So, increase the money supply through purchasing bonds, right? We buy bonds and we issue electronic money, and thereby increase the money supply through monetary policy, not through interest rate policy, but through these open market operations, what they're called. And so yes, I mean so these would be the two policy experiments, and there's basically you try to counteract some of these macroeconomic shocks and soften the fall on the way down, but then also if the economy expands, then try to get ahead a little bit and get ahead of the curve in inflation and try to prevent that we have something like this spiral of prices, higher inflation, higher wages, and then higher prices like in the 1970s. So in this monetary policy targeting your short-term interest rate policy is that seems to be a very efficient tool to basically keeping the economy stable, keeping inflation stable, and softening some of the blows that the economy experiences.
So I feel like what I hear you say is we're talking really about the different tools that the Federal Reserve and the government has at their disposal for both heating up and slowing down the economy. And I just wanted to point out that I feel like the hyperinflation probably doesn't start out as hyperinflation. It probably starts out as maybe runaway inflation or inflation. And runaway inflation doesn't start there. It probably starts out as transitory inflation or some variance thereof. So really the difference between transitory and hyperinflation or transitory inflation versus hyperinflation is just that transitory at some point stops, right? Like it's something has happened. And so with that framework in mind, it's kind of to me, I'd just be, you're aware of all these tools. You know how so when you look at the data and you see these numbers that come out like the CPI, et cetera, like this rate was at 5%, normally it's over here, and year over year, are you kind of just at the same level as the rest of us with hyperinflation, like it when you see it? Or do you have any sort of advantage of saying, hey, this is no longer transitory, this is runaway, and this is runaway where I don't see an end game in place? Like, what would you look at to say, all right, the thesis is about this just being, we're kind of doing our own form of a reset right now? At what point, what do you look at to say, is it the wage spiral? Is it a supply and demand? That thesis doesn't map out. Inflation is just everywhere. Like, what tells you we're trending out of transitory and into the next phase of inflation?
Yeah, I mean, if we have 8% annualized inflation for the rest of the year, I would get a little bit worried, right? I mean, and I wouldn't completely discard the possibility, right? Because we probably are going to see some increases in wages, right? And so this, could create some sort of self-fulfilling prophecy. And I mean, everything, if this continues into 2022, this is probably no longer transitory. So this is probably more self-fulfilling. And I mean, everything points to strength in prices, right? So we have very solid GDP growth, very low interest rates, a lot of spending. And then on top of that, it sounds like that workers only have now a little bit of pricing power, right? So, again, I'm not...
What do you mean by that? They only have a little bit of pricing power?
Right. I mean... for example, the other day I read that, hey, nobody's talking about a $15 minimum wage anymore, right? Because especially in a lot of places where people were complaining about, hey, I mean, nobody can live here with $15 an hour, say Seattle or San Francisco. So I heard that, for example, In-N-Out Burger in San Francisco is paying $18 an hour, right, starting salary. So there's definitely some pricing power. If you want to entice people to come back to work, you have to pay up. And there is some increase in wages. Now, obviously, people working at McDonald's or In-N-Out Burger, right? I mean, they are not the marginal price setter in the labor market, right? I mean, I don't see the big price hikes for, say, government workers or in the finance sector or in many other areas. So, cross my fingers, this is probably not going to be a wage price spiral, but I mean, there could be a transitory effect too, obviously in the labor market. And by the way, a lot of people are going to say, well, this is just making up something where people have been lagging anyways, right? So I have noticed that for a long time, and people have pointed that out, right? If you look at the split between value added, right, GDP sums up all the value added that is added to the economy, right? And how much of that is really paid towards capital owners, and how much of that is paid towards workers. And normally they were holding each other pretty much in balance. So maybe 2/3 of value added was paid out to workers and 1/3 was paid out to capital owners. And there was a little bit of an erosion in labor income as a percentage of that value added. And if that's coming back now, it might even be something that we should welcome. It's just a normalization of something that of a trend that wasn't sustainable in the first place. Right? We should have some equitable and fair distribution of capital owners versus workers. If workers are making back some of the ground that they lost over the last 10 years, might not be such a bad outcome.
So that erosion was in the last 10, 15 years?
Oh, yeah, 10, 15 years, something like that. Yep.
So the next place I want to take this is actually, and selfishly, I think this is what most people listening to this call are interested in, myself included. What does inflation, whether you're talking about transitory or hyperinflation, whatever it is, what does inflation mean practically for investors, investors at all stages, investors that are the accumulation phase, investors that are in drawdown, investors that are invested in stocks, investors that are invested in bonds? What does inflation mean for us as investors on the path to financial independence?
Yeah, so depends on your asset allocation, right? So if you're very heavily invested in stocks, and by the way, if you're early on your path to FIRE, I'm not going to blame you if you have 100% equity, 0% bonds. Right? So if you're very equity heavy, you could argue that inflation is not going to be such a big headache if you have an equity portfolio, because over the long term, equity market is going to keep up with inflation plus then some, right? I mean, historically, stock returns have been somewhere around 6.7, almost 7% above the inflation rate over the last 150 years. And even if that real return might be a little bit leaner going forward, but you could argue that equities should keep up with inflation over the very long term. It's not the case for bonds, right? If you have a nominal bond portfolio, or you have CDs, or you have an annuity as a retiree, or you have a pension, a corporate pension that is just a nominal amount and it doesn't inflation adjust, then inflation is going to be a much bigger headache for retirees, right? First of all, you could have corporate pensions that are eroded away by inflation. You might have a larger bond portion in your portfolio. And you might also get dinged because, as I said, even though equities are going to keep up with inflation over the very long term, again, the whole problem with sequence of return risk is that it's the short to medium term. If equities were to go down over concerns that we have an inflation shock and the Fed is going to cool down the economy, that could also in the short term be a headache for retirees. So the retirees definitely have a lot more to worry about from an inflation shock. Again, they have more nominal exposure from nominal asset classes, and then they can't so easily sit out a drop in the equity market. Whereas if you are a fresh enthusiast in the FI and FIRE movement, and you just start out investing, even if you have in the short term a bit of a dip in the equity market, right? You just keep investing. You do the dollar cost averaging. I've done that in 2000. I got my first job. I went through the dot-com crash, and I kept investing through that. I got a big pay raise in 2008, moving into the private sector, and did the dollar cost averaging through the global financial crisis. Worked out extremely well, where I experienced a big market crash right at the beginning of my investing career, and then at the doubling down my investing and doubling or even tripling down my contributions into my portfolio. And then right around that time, we had another market blow up. So if you're right at the beginning of your investing career, skip the bonds, just do the 100% equities, and then do the dollar cost averaging if there is actually a bit of a dip in the equity market. But again, I don't want to minimize it too much, right? So if there is an inflation shock and the Fed has to go overboard, it creates a lot of uncertainty. There is potentially could lower earnings for some of corporations that are very heavily leveraged if interest rates go up. So there's some direct and indirect effect on the equity market. Don't try to minimize that. There's a big precedent in the 1970s and early 80s. Interest rates went up during the Paul Volcker period, and that created a recession, created a bear market. So definitely short term, that is something that should be on your radar screen as a retiree. But as a fresh young investor, probably not so much.
Right. And that ties into what you were saying before, which is, if I can read between the lines, it doesn't sound to me that you're terribly worried about runaway inflation or anything, but we can't be naive, right? Like you said, we have to see what happens in 2022 and we'll reassess, right? So, but what I'm hearing you say is if you're the vast majority of the audience listening who's on the path to FI, you would probably advise just keep doing what you're doing, which is dollar cost averaging into equities. Just don't do anything crazy. Am I hearing you right? Is that what your advice would be to the young Carson?
Right. And filter out the noise, right? Just remember only 10 months ago or so, right? Everybody was worried about low inflation, right? And then people were running around and saying that, oh, this is great for retirees because if the inflation is low, you have to do less of adjustments to your spending, and that might even allow you to increase your safe withdrawal rate. I didn't find that argument too compelling. And now we have almost this overreaction potentially on the other side, right? Where inflation is obviously much higher than standard, and so don't always extrapolate some short-term trend into the future. So more likely than not, we'll normalize again, potentially even have a bit of a hangover once people stop buying RVs and the dishwashers and refrigerators and remodeling their homes, right? What if we bring all of this excess capacity on and then people stop doing what they have been doing, and we might even have a little bit of a crash in some of these very hot commodities right now.
You said something before, the Fed would cool down the economy. So again, from a non-economist perspective, is that the implication is raising interest rates? Is that what happens in that environment?
Right, raising interest rates, stopping these purchase programs of bonds. Potentially, it's not that they would necessarily dump all of these securities back into the market, but what they could do is they could just let the ones that expire, that mature, don't purchase back new securities once a security matures, and so that would still that would have somewhat of a cooling effect on the economy, and certainly, as I said, higher interest rates. Right, higher interest rates factor into a lot of different aspects of the economy: higher mortgage rates, higher rates for lines of credits, and that could be a cooling down of the economy that way.
Are there any implications for savers, for people in the FI community, if interest rates did go up? Like, are there positives potentially?
Right. So, for example, what if you are retired, right, and you have some fixed income securities in your portfolio, right? If you, of course, if you have nominal bonds, right, or CDs, and they have some fixed nominal interest rate, it means that if inflation is higher, 1-for-1, it's going to erode your real return of that, right? There are some other instruments that have, for example, floating interest rates. Right. So I have one little account. It's actually not little. It's over 1/3 of our net worth, where I do some option trading. Right. So for option trading, it's a derivatives trading strategy that I do.
Don't try this at home.
And don't try this at home. Exactly. I say that on my blog too. But there's some people that got interested in that, but it's probably not for everybody. But I have to keep some relatively stable assets as collateral, right? And because the derivatives is all on margin, and I have to keep some. So I keep some money in a margin account, and I don't want to keep that in stocks and then have basically twice the risk, once from the derivatives and once from the stocks. And I don't want to keep it in just very boring government bonds. So I have this middle route where I invest that in preferred shares. And so the nice thing about preferred shares is that there are some that have floating rates. Right? So floating rates means that if the interest level changes, then your interest income goes up and down 1-for-1. So and some of them actually, the nice thing is they are so-called fixed, so floating rate preferred shares. And they are currently fixed rates, and they pay something like 5% or so. And they are fixed until, and it depends on which security you have, until maybe 2023, 2024. And then they transition to floating. And I thought that might be really perfect, because I have the fixed rates that are pretty decent for all the time when the Federal Reserve probably keeps interest rates really low. And then once they start raising their interest rates, especially so now it looks like 2023 is roughly when we start normalizing interest rates again. That's exactly when a lot of these preferred shares transition back to floating. So I thought that that is really good timing. And by the way, I bought these a long time ago, so I bought these actually pre the pandemic. And again, as a pre-pandemic, my thought was, hey, I want to have something that has some floating aspect to it, where if we have an inflation shock in the future, I want my interest income to go one for one. So I don't have this effect of, say, you invest in a fixed nominal bond and you get 3%, and boom, inflation is 5%. So you have a negative real return there. On the other hand, if inflation is only 0%, then you get to keep everything as your real return. So I don't like this inflation risk in my portfolio. So having something that is floating sounds like a good compromise. You want to have something that is a little bit less risky than stocks. Has some preferred shares. They have some aspect of obviously shares, right? I mean, they pay a dividend, and they are not quite as safe as bonds. So in terms of the risk profile, this is a hybrid between stocks and bonds. So don't get me wrong. This is not comparable to, say, the government bonds. This is a lot riskier. But if you can get something that has a floating rate, so that would definitely be a good hedge against this inflation shock. But then guess what? Recently, the values have gone up a lot, right? So because obviously everybody is now getting into this instrument, because this now looks like a very, very attractive hedge against some of the risk profiles that we might be facing there. But I mean, so in terms of the yield, I mean, that's still an interesting alternative. Not quite as risky as stocks, but you get a little bit of an inflation hedge still.
Yeah, that's interesting, because when you hear floating interest, my mind immediately goes to like an adjustable rate mortgage, and it's funny because it's the exact opposite right now. So the interest rates are historically low. Lock yourself into a fixed rate 30-year, but you're saying on the opposite side, on the investing side, you could potentially benefit from, in your case in particular, right? Like this could float up in a couple of years.
Because remember, now I am the creditor, and I like to have some hedge against higher interest rates.
So if we look at the profiles of the investors that are on this path, we just mentioned, for people in the accumulation phase, largely like inflation could work on their behalf in kind of two different ways. On the one end, inflation can kind of elevate stock market prices and values, increasing the value of your holdings, which would largely work for investors. And then on the other end of that, if there were some sort of inflation-induced crash, you are basically saying crashes were two of the gifts that helped you get to where you are now because you dollar cost averaged your way to those. So for someone on the path to financial independence that's saving, buy the dip. Dollar cost average, buy as you go, long-term buy and hold. You're buying a sale or a fire sale in varying cases. And if you're still there on the other side, if you're a long-term buy and hold index investor, it is going to act as a force multiplier to get you where you want to go. That's really the first phase. And then you're adding on a level of nuance. So when you're talking about people that are in drawdown, because both of those advantages now become disadvantages for someone that's in drawdown. On the one end, inflation is working against some of the instruments, some of the assets that you're holding. In the cases of bonds, if your bonds or your yields are not inflation adjusted, if your pension is not inflation adjusted, the inflation is eroding what you're getting, what you're living off of. So you have that working against you. On the other end of that, if you have a crash, then the income that you're relying on is now worth less as a whole. And so that's where we need to start thinking through, is our strategy strong? And if a lot of this is accounted for by the 4% rule of thumb, or in Ernst's case, the 3.5% rule of thumb, I mean, this is where we're talking about, what happens over the first 3 to 5 years of your portfolio is going to really determine your success rate by and large. So we're paying more attention that if we have the characteristics, if we're in this kind of time horizon. And then you're pointing to some additional strategies, and you just talked about preferred shares, and you were mentioning, all right, are there assets out there that have some sort of floating interest rates, some sort of ability to keep pace with inflation, whatever that may be. I'm curious in your mind, are there other asset classes that start to hold more appeal for you or that are more interesting to you when you start looking at specifically, I am in the drawdown. I'm in this phase that you're talking about, and I would like to have some sort of hedge for exactly the scenario that you're talking about. Is it just a big pile of cash that has its own problems, right?
Right. So, obviously real estate, right? So real estate, both as so for example, we have our own primary residence. It's paid off. We don't have any mortgage. So just taking that big chunk out of your retirement budget that would be paying rent, that's a pretty mandatory expense. So already taking that out of the equation, I think that definitely is a pretty solid hedge against inflation. Even though, funny thing is,
I was just going to push back on that. I don't know. Were you going to talk about paying off if you have a fixed rate mortgage in light of what we're just talking about? Do you rush to pay that off?
No, okay. Two funny things. Let me get it before I address that one. Funny thing is, actually, over the last year, rental inflation hasn't been that high, right? So part of it obviously is that renters are moving into the suburbs and buying homes, so probably renting has become a little bit less attractive. Then it's become a lot less certain for a landlord to actually get paid, right? There's still a lot of places where if renters don't pay, they can't be evicted. So it's definitely put a little bit of a damper on rental inflation. But if you look at something over the last 10 to 20 years, rental inflation has been higher than the overall inflation level. Right, so overall inflation was 2%, rental inflation was 3%. So there's something about owning a home and hedging that mandatory expense and not having to fund that out of your volatile portfolio. And then obviously, do you pay off your mortgage? Do you not pay off your mortgage? And the same thing as before. So as I said, if you are new on your path to FIRE, absolutely don't accelerate your mortgage payments, right? Use all of that leverage that you can get out of your mortgage. Then obviously once you get close to retirement, if when we bought our house in 2018, we paid cash. If I had used that money and put it in the stock market, I probably would have made more than having that paid off house. But again, there's something about peace of mind, and at least historically, it has worked out such that you would have been a little bit better off if you don't have that mandatory expense of that mortgage. But I can see what he's saying. You should have just levered up that house back in 2020 or so, and put it all in the stock market. Take out a home equity line of credit, put the money in the stock market, and it would be really golden now. It worked out really well over the last year. It doesn't mean that's really the best strategy going forward. So we're very happy with having a paid off house. I guess as a diversifier, a lot of people use real estate, right? So we have some private equity funds that invest in multifamily real estate, and that has worked out pretty well for us. And the funny thing is, it's not like you can move that money very quickly. So one click, I can invest $1 million in an equity index fund, right? Or move it out of one fund and into another fund. It doesn't work so easily in the real estate world, right? Those are very lumpy investments, and if you go through a provider like the ones that we use, they're closed, right? They have some funds that they're managing, and then you have to wait until they market a new fund, right? And then you commit a certain amount into that, and then pay it, probably not all at once, but then in stages. Funny thing is, our equity portfolio has grown by so much, right? Even though I wanted to grow our real estate portfolio, and we did grow it, but there's actually the equity portion has grown more. So the percentage of that real estate portfolio is still much lower than I would like it. But real estate is obviously something that keeps up with inflation, right? The value should keep up with inflation. The income keeps up with inflation, and as I said, actually the income has grown faster than inflation, just because rental inflation is always running a little bit above the overall inflation rate. So that would be another route if you have the stomach for that. If you want to do that as a mom and pop landlord, or through one of these big online marketplaces, right, where you can invest in real estate through that syndication platform, or as basically some of the old style private equity funds, right, that have been. I mean, some of the funds that we're using, they have been doing this for decades already, for 20, 30, 40 years. Before there was even an internet, right? There was already this crowdfunding aspect of real estate investments.
Yeah, it is nice. You can kind of get in on even regular investors, right? There's places like Fundrise, and I know there's Yield Street and Peer Street. Yes. I'm not advocating necessarily any of these, but yeah, they are available. And I did have one question for you in there. So you talked about, kind of your diversification. You had, it's maybe a target percentage for real estate, and obviously it kind of got dwarfed by the growth in equities. Do you intend to rebalance? Like, is that something that you intend to sell some equities and buy more real estate? Has that crossed your plate yet?
No, I mean, I would never sell equities, right? Because then you have these big capital gains consequences there. So that account that I use for the option trading, it turns out that some of the margin cash that I invested, that there's a little bit of a capital appreciation, but it's not as dramatic as what we would have in some of our Fidelity equity index funds. So if I want to move money into real estate, I would take it out of that Interactive Brokers account, where we have there's some built-in capital gains now, but I guess I could still find some tax lots here and there that have only 10% appreciation, and because again, I mean, I only do that investing that margin cash is just to generate some supplemental income. The actual income is mostly from the option trading, and so also the nice thing is that again, I wouldn't take. I wouldn't buy one single family house for, say, $400,000 and then take that all out in one big chunk and put it into a real estate investment. The nice thing about some of these syndication websites, or also some of the private equity funds that we use, is that you can commit relatively small amounts. And then even if you commit, say, $100,000, it's not called all at once, right? It could come in 5 steps, each $20,000 spread over the next 2 years. That should be pretty manageable. We have one commitment, which is a $250,000 commitment, and recently there was a call of $72,000, so we had to come up with that money all at once. I mean, so there's always some money sitting somewhere, so we don't have to take it out of the equity portion. And so right now, I'm just letting the equities run, take the dividends, obviously, so you can live off the dividends, but liquidating the capital gains, I try to defer that for as long as possible.
So we were talking about this through the lens of what are the options for bondholders, or for people that are in drawdown who want to diversify their asset classes to potentially act as some sort of hedge against some sort of inflation, whether it be transitory or not. And we talked about preferred shares. We just talked about real estate, either through mom and pop, just do it on your own, or how you can access scale through syndication or private equity firms. You mentioned being golden earlier. I'm actually curious, what about gold? What about precious metals? What about commodities? What role do these, in your mind, as we're talking about inflation, we just talked about how commodities kind of shot up. What role do precious metals and commodities have in terms of being a hedge against inflation for an investor?
Yeah, so again, if we look at the very long-term returns, what were the nominal and real returns over the last 150 years? Right? So equities came out ahead as basically beating everybody, leaving everybody else in the dust with almost 7% return above inflation. And gold, so basically just buying 1 ounce of gold and putting it in your safe or burying it in your yard, over the last 100 years would have kept up with inflation, but only barely. So I think I calculated was something like a 0.7% annualized return over the 150 years. And so quite intriguingly, the one asset class that is often referred to as the inflation hedge actually had the lowest inflation-adjusted return over that long time window. And but then again, gold definitely rallied in all of the previous big market crashes, right? And especially the big market crashes that that were a concern from the perspective of sequence of return risk, right? So it would have worked during the Great Depression, it would have worked during the 70s, and then of course if you use gold in historical simulations, be careful, right? Because the gold was not really available as an asset where you could just pile up gold. And there were some time periods where you were not even allowed to trade gold. So there was a gold price, but it wasn't really an investing asset in that sense. But but yeah, I mean, for example, even in 2020, gold would have been a good hedge against the equity drop. So there is some. There is some advantage of having gold in your portfolio as a pure hedge, but don't expect gold to make you outsized returns. And then on top of that, is also quite volatile. But then again, I mean, volatility by itself is probably not the biggest concern, because the volatility could mean that, it becomes really volatile. It goes up a lot when equities go down a lot, right? So that's the good type of volatility.
It was actually the place that I was going to push back on just a little bit in the fact of, like, with gold, I mean, maybe gold for 150 years is great. The longer you hold it, the better. But generally, I think most of us in this community are like, most of us just love equities. We like the idea of it. But in the lens of, is there some sort of inflationary period coming, and just thinking about human psychology and how we associate precious metals with some sort of store of value case, in that scenario, does gold run? You just mentioned the volatility. In the past, we've talked about, Frank, about, when we talk about diversification, really what we want is negative correlation. And unfortunately, what we just said is, right now, if individuals are diversifying by holding stocks and bonds, and in an inflationary period, bonds don't perform as well as maybe we would like them to, I wonder in that scenario if, some small percentage of a portfolio were allocated towards precious metals, if in those windows where that volatility is really working for us. And I was really curious, because it seemed like you were kind of narrowing the scope there. I don't really care about what the returns were of gold over a 150-year period, but I'd be very interested in knowing, over these inflationary periods, what were the aggregated returns over that period of time?
Oh, no, I mean, you would have had, and again, so the gold returns obviously were extremely attractive exactly during the times when equity returns were really poor. So yes, absolutely. So you would have made, this would have been a good diversifier if you could have traded gold, and obviously there's some transaction costs involved. If you buy an ounce of gold and you sell an ounce of gold, right? There's a bid-ask spread. If you hold it through an ETF, there's obviously an expense ratio. You have to pay some ETF provider for the services that they provide you. Probably the cheapest way to hold gold is through futures contracts, but that's probably also not the most workable way, because there's certain minimum investments. You have to buy a contract that is 100 ounces worth of gold, right? So there's some. So do you buy one contract or two contracts? So there's 100 ounces versus 200 ounces. So you can't just buy 17.4 ounces of gold in the futures market, right? There's some constraints as to how granular you can get there. And so I haven't invested in gold myself. I wrote a blog post about how gold would play into safe withdrawal strategies, and what if we mix in a certain amount of gold exposure into your portfolio, and you simulate that. And there was some benefit of including gold, maybe to a maximum of 10 to 15%. And so that would have worked out in past recessions and past bear markets, and would have cushioned a little bit that sequence of return risk. So again, if you are retired and you want to hedge that equity downside, it's something to keep in the back of your mind. Probably for young investors, I would still go 100% equities, but once you get closer to retirement, like a precious metals ETF or something around those lines, especially considering that, if you buy a government bond fund, right, and it yields 1.5%, and the inflation rate it's already bad enough if the inflation rate is 2%, right? If the inflation is 4 or 5%, you're putting money into an investment that has a negative real interest rate. So just from a purely expected point of view, you could do potentially better with the gold allocation.
Yeah. So. No, thank you. That's the nuance that I was kind of looking for, and it tracks. Just it makes sense to me at this point. The idea of having a swimming pool full of gold, a la Scrooge McDuck, 1988 DuckTales, sounds very unappealing. I do not have the budget nor the the desire to guard that with laser guns pointing from everywhere but the idea of having some amount of precious metals being held in an ETF or physically or whatever it may be, if you are thinking that you're going through some sort of inflationary period and you're in a stage where you cannot tolerate that level of volatility combined with inflation eroding your bonds purchasing power, it seems like you could make a pretty strong thesis that is something to do some research on. So you've given a lot of good options on this call. I know just for people that were kind of thinking about some of those, what to look into, we mentioned real estate, which is not a surprise probably to anybody listening, but we also talked about preferred shares plus float. And we mentioned precious metals and potentially commodities, but precious metals like gold and silver, just how those might line up for someone. And so Carson, I know you've had articles on at least a couple of these topics. We'll definitely include those in the show notes for individuals that are listening to this that want to go further. And I would encourage everybody that's listening to this episode that wants to just think about this concept of sequence of return risk. I need this money to be there for me, and I'm in the first 3 to 5 years of my retirement. So what happens over the next 3 to 5 years is really, really important in terms of my overall retirement success. That is what we call sequence of returns risk. And Big ERN over at Early Retirement Now has written the ultimate guide to safe withdrawal rate and sequence of return risk. Highly recommend that you check that out. You can find that series at earlyretirementnow.com. So Big ERN, with that, thank you so much for joining us on the show today.
Thanks for having me.
All right, everyone, that was a hugely informative episode, and a big thanks to Big ERN coming on the show today, breaking down some of these topics that frankly are just outside so many of our comfort zones. And it really is important. If inflation is in fact here, if we're seeing it, if it's something, it's something that absolutely does have an effect both on our daily lives and potentially on our investments and our investment portfolios. And I thought it was just a wonderful opportunity to understand what are the macro and microeconomics that are going into it. and who should be really paying attention. And I just loved how Big ERN was able to give us the framework for that conversation. And I hope you got some actionable content from this episode. Be sure to go to his site and check out the articles that we're linking to in the show notes for today's episode. And if you're new to the concept of financial independence, let me encourage you to go to choosefi.com/start. That's where we put all of our resources for individuals that are on this path in one easy to access place. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.